GRT is bleeding out at 2 cents, and retail is completely abandoning ship. But what if I told you the underlying protocol just posted a 300% revenue surge driven by autonomous AI agents? Everyone is focused on the massive $20 million inflation deficit, missing the fact that artificial intelligence just organically selected this network to bypass Ethereum gas fees. If you misread this market structure right now, you are going to miss the exact same fractal that triggered a 600% expansion in 2023. Today, we are stripping away the emotion. I'm going to walk you through the hard, on-chain revenue data, the extreme inflation risks, and the exact weekly chart levels where my capital is deployed. Right now, the graph is sitting at roughly 2 cents. We are scraping the absolute bottom of the all-time low support box. The market sentiment is pure, irrational fear. You look at the timeline and people are giving up. But as a data-driven investor, this is exactly where you have to separate emotion from market structure. Over the past months, we have seen consistent pressure pushing the price down, leaving us below both the 21 and 55 exponential moving averages. That red line and purple line on the weekly chart are acting as heavy dynamic resistance. Yet, while the price action looks like a slow bleed, the actual usage of the network is telling a completely different story. There is a massive divergence between what the token price is doing and what the protocol is actually building in the background. Most retail investors look at the chart and walk away. But there is something buried in the recent 2026 roadmap and the on-chain financial metrics that completely changes how we should value this asset moving forward. Let me show you exactly what the smart money is tracking. When you look under the hood, the fundamental growth is undeniable. Active subgraphs just hit a new all-time high of 15,500. But more importantly, substream revenue surged 4 times quarter over quarter to over 6 million GRT. That is the highest on record. The network is clearly monetizing its high-performance data pipelines, but they are not stopping at basic indexing. The new 2026 technical roadmap introduces AMP, an SQL native blockchain database built for enterprise scale. This drastically increases their total addressable market. Now, here is the catalyst that few truly grasp. We are moving into an agentic artificial intelligence economy, but those agents cannot easily pay Ethereum Layer 1 gas fees. The graph solved this with the X402 standard, using cryptographically signed vouchers that settle in batches off-chain. This essentially turns the protocol into a zero-friction data marketplace. We already saw a live test where Claude organically hunted down the right subgraph and crafted queries to pull real-time on-chain data, completely unprompted. It just knew this was the optimal route. However, we have to look at the bearish data too. Despite this technological leap, the token holder base is totally flat at 171,000 addresses. Retail does not care. And financially, the protocol is bleeding. Over the last 365 days, they generated about $370,000 in revenue, but paid out $20.7 million in token incentives. That leaves them with a negative $20 million earnings deficit, capturing 74% of the negative earnings market share among infrastructure peers. With only 24 core developers active on GitHub, it is a lean team pushing a highly inflationary token model. They are subsidizing network security with massive dilution. You have to factor this heavy inflation into your risk management. So, how do we trade this heavy dilution against the massive utility? Look at the weekly chart. The graph is currently trading inside a massive falling wedge that formed in late 2024. The price is resting exactly on the absolute bottom of our macro support zone at 2 cents. If we lose this box, the technical setup is completely invalidated. But right now, we are holding. Notice the macro yearly descending trend line, that orange dotted line coming all the way down from the $2 all-time highs back in 2021. We saw brutal rejections there in late 2021 and two more times in 2024. To even test that trend line again, we first have to break out of this current falling wedge and reclaim the critical resistance zones at 5 cents and 8 cents.
But this is where history gives us a roadmap. I'm seeing the exact same pattern and retracement play out from the 2021 to 2023 cycle. Back then, that identical wedge structure resulted in a 600% explosion measured from the breakout point. Before that, the destination was the 1618 Fibonacci extension. So, watching the same fractals, I anchored the current Fibonacci retracement from the 7-cent low in 2023 up to the 50-cent local top in 2024. And now, GRT is right back at that exact 1618 level. In the previous expansion, the price pushed up toward the 618 Fibonacci. If this fractal repeats, we could reach that descending trendline resistance, which lines up perfectly with the next 618 Fib at 15 cents. My personal strategy here is capital preservation first. I am holding my long-term bag through this peak irrational fear. I'm not selling a single token at the all-time lows. When and if we hit my first major profit target at 7 cents, I'll take some off the table and move my stop loss to entry. If we reach the second target at 15 cents, the stop loss moves to target 1. My final major target for the next 12 months minimum is 50 cents. The Heikin-Ashi Relative Strength Index at the bottom of the chart is showing extreme oversold conditions, hinting at a bottom, but it is still pointing down. We need a strong, definitive green weekly candle to reverse this momentum. When you synthesize the data, you have a protocol operating at a severe financial deficit, relying on high token inflation to survive. That is the worst-case scenario if demand never catches up. The price simply bleeds out below 2 cents and the chart is broken. But the upside case is that the agentic economy adopts the graph as its default, gas-free data layer. If those queries outpace the token emissions, the market structure flips entirely. We're looking at a potential timeline targeting Q4 of 2026 to hit that 15-cent level. If we break that macro descending trend line, the entire landscape shifts. I prefer to play the probabilities here. The risk-adjusted return down here at 2 cents, armed with strict invalidation levels, is highly asymmetrical. In my honest opinion, the graph is a high-risk, high-reward infrastructure play, bridging AI and decentralized data. But you have to respect the inflationary headwinds. Do not fall in love with the technology. Trade the levels and protect your capital. If you found this data-driven approach valuable, hit the like button and subscribe to the channel. Also, join my free Telegram group for faster daily updates. You will find the link pinned in the comments below. I highly recommend you watch my last video about the graph for the full story on how I built my initial position, as well as my recent breakdown on BitTensor, which is another massive long-term play. Remember, none of this is financial advice. Thanks for watching, stay rational, manage your risk, and I'll see you tomorrow in the next one.